Hello. On behalf of Fair Value Academy, welcome to the session on Goodwill impairments. Just a quick background about Fair Value Academy. We are an online platform providing content on valuation for accounting and financial reporting purposes. Let's jump into today's session. The first part will cover the basics about what is Goodwill, and then we get into the more technical accounting and valuation aspects of Goodwill impairment. So in this module, we will talk about what is Goodwill and how does it arise on balance sheet. What is Goodwill? Goodwill is an intangible asset. Now, there are other examples of intangible assets such as brands, patents, trademarks, amongst others. Most businesses will have some form of goodwill. A simple example of goodwill is the assembled workforce of a company. The cost, effort, and time that is taken to hire, train, and then bring employees to full productivity and then get them to work together has value. And this value falls under goodwill. Another example of what constitutes goodwill is if a company's brands, patents, trademarks, etc. cannot be separately recognized on the balance sheet as an intangible asset because they may fail to meet the accounting recognition criteria, then its value will fall under goodwill. How does goodwill arise on balance sheet? This is best illustrated through an example. I will use Heinz acquisition of Kraft to illustrate further. Before being acquired, Kraft would have created goodwill. As mentioned earlier, there is value in putting together a workforce. Furthermore, Kraft also developed several household brands. However, these intangible assets, goodwill and brands in Kraft's example, are internally generated, and according to the accounting standards, they are prohibited from being reflected on Kraft's standalone balance sheet. Yet, upon completion of a M&A transaction, the accounting standards then allow these once prohibited intangible assets to now be recognized on the consolidated balance sheet of the merged entity. Let's explore these points further and understand why the accounting standards prohibit companies from recognizing internally generated intangible assets on balance sheet, but then allow it after an M&A transaction. Why is this? Because it's difficult to accurately value intangible assets. Each one is unique, and there is no active market for intangible assets. While certain valuation techniques can be applied to value intangible assets, there is a high degree of estimation uncertainty. Now, in a M&A transaction, however, the consideration paid justifies the value and sort of provides a cap or a ceiling. Let me illustrate this. In this example, management of company ABC have optimistically valued their internally generated intangible assets, such as their technology, brand, and goodwill, at $500 million. Remember, since these intangible assets are internally generated, the accounting standards prohibit them from being recognized on balance sheet. Now, a few months later, 100% of company ABC is acquired in an arm's length transaction for a consideration of $300 million cash, which was paid by company XYZ. Now, assuming no debt, if the fair value of company ABC's tangible assets are worth $100 million, then their intangible assets can be worth no more than $200 million. The purchase price of $300 million justifies this value and provides a cap. That is why the accounting standards will allow $200 million of intangible assets to be recognized on the balance sheet of the merged entity. The $200 million will need to be allocated between brands, patents, and goodwill. However, this is outside the scope of this session and we will cover it under our session on purchase price allocation. Okay, back to our Kraft Heinz example. After Heinz completes its acquisition of Kraft, we now understand that Goodwill and brands of Kraft can now be recognized on the consolidated balance sheet of Kraft Heinz. So the key takeaway from this module is that the only instance when intangible assets, including Goodwill, can be recognized on balance sheet is upon completion of an M&A transaction, that is a business combination in accordance with IFRS 3.